Welcome to Market Dive, the show where we really try to take a deep dive into all things finance. I'm Kian,
And I'm Nika.
and we are so glad to have you here for our very first deep dive.
Today we're going to be tackling a topic that's always generated a lot of discussion, I think, among investors.
Yeah.
Stock market seasonality.
Mm.
So does the time of year really have any impact on how the market performs?
And if it does, like, what can we actually learn from those patterns?
So we'll be looking at data that spans decades to see if certain months have historically been better for specific indices.
Okay, so like the S&P 500.
Exactly. The Dow Jones Industrial Average,
Wow.
the Nasdaq Composite.
And we'll even be looking at, do small caps have their own kind of special season?
Yeah.
Okay, so let's just jump right into the data and see what we can find.
All right, so I think a good place to start will be to kind of dissect a well-known market adage. Sell in May and go away.
Ooh, okay.
So the idea is that stocks tend to underperform during the summer months.
So we're talking May to October, basically, just stay out of the market. But is there any truth to this?
Well, if we analyze the S&P 500's performance from 1992 to 2024, the data reveals a slightly more complex picture. So while June did have a historically low average return of just 0.1%, the period from May to December actually saw an average return of 4.9%.
Okay. That doesn't sound like something to run away from. And to even further kind of challenge this whole sell in May idea, May 2024 actually had a really strong gain, 4.6% for the S&P 500, which was one of the best May performances in over 70 years.
So, this really brings up the question, is sell in May becoming outdated? Or are we actually seeing like a change in the way the market behaves?
Yeah, it really makes you think. So let's move past this adage and dig deeper into the S&P 500's history, with seasonality.
Yeah.
The data shows that between 92 and 2024, the S&P 500 actually had positive returns about 63% of all months.
So that does point to, an overall upward trend. But as we've seen, some months tend to do better than others.
Yeah, and looking at the average monthly returns for the S&P 500 during this time, April, November, and December, those are historically strong performers.
Yeah, so April averaged about 1.5%, while November and December were about 1.4.
But it's really important to remember that each month can have a pretty wide range of returns. For example, April 2020, that year, the S&P gained a whopping 13.6%.
Wow.
Some other standout months include March 2000, which had an 11.6% gain, and July 2022 with an 11.2% gain.
But then there were also some notable losing months.
Yeah.
Like August 1998, which saw a pretty big drop of 14.8% for the S&P 500.
All right.
June 2002 wasn't much better, with a 12.6% decline. And October 1998 came in with a 12.2% loss.
So, I mean, while some months might have, historical advantage, it's clear the volatility can happen, at any time.
Right. Past performance isn't necessarily indicative of future results, and any month can have its ups and downs.
Absolutely. So let's kind of zoom out a little bit, look beyond the S&P 500. How does some of the other major indices like the Dow Jones Industrial Average, the Nasdaq Composite, how do they stack up when it comes to seasonality?
So both the Dow and the Nasdaq generally exhibit positive trends as well. And from 1992 to 2024, the Dow actually had an average monthly return of 0.9%.
Okay.
And the Nasdaq was slightly higher at 1.1% over that same period.
Well, what about like their best and worst months?
So for the Dow, October 2022 was a really good month. We saw a 12.2% gain. April seems to be a historically strong month as well. Like in 2020 and 1999, it saw gains of 12 and 11.8%, respectively.
Wow. But it looks like August might be a bit of a tough month for the Dow, historically speaking. In 1998, it had a 15.3% drop. Yikes.
And September 2001, not much better, with a 13.5% loss. And August 1990 also saw a 13.4% decline.
Okay, so shifting gears to the Nasdaq, its best month ever was April 2020, with a massive 16.1% gain. July 2022 also stands out, with a 14.7% surge. And October 2015 gave us a really solid 13.1% gain.
But, the Nasdaq has also seen some difficult times, like January 2008. That was a particularly rough one, with a 12.5% loss. September 2008 came right after with a 12.2% decline. And December 2022 also saw a pretty significant drop of 11.5%.
So it sounds like, while the Dow and the Nasdaq have shown overall positive trends. Specific months can definitely bring some volatility, some potential downsides.
Exactly. So we've been talking about these broad market indices, but what about like different types of stocks? Do small cap and large cap stocks, for instance, have their own like unique seasonal patterns?
That's a really good question. And the data actually suggests that small cap stocks, those represented by the Russell 2000 index, tend to outperform large caps during one specific period,
Yeah.
mid-December to mid-February.
And this often coincides with tax loss harvesting and year-end portfolio adjustments that investors make.
Can you explain a little more about what tax loss harvesting is and how it, contributes to this small cap outperformance?
Yeah, so tax loss harvesting is basically a strategy where investors sell investments that have lost value in December. And they do this to offset capital gains that they might have made throughout the year.
Okay.
And this helps reduce their overall tax burden. And a lot of times those sales involve large cap stocks, so it can create, a temporary dip in their prices. And
Yeah.
that gives the small cap stocks a chance to kind of take the lead.
So an investor might want to think about tilting their portfolio, towards small caps during that December to February window, to maybe capitalize on that historical trend.
And then maybe switch back to a larger cap focus for the rest of the year. But of course, any investment strategy should always be based on your personal risk tolerance and your own financial goals.
For sure. Now, beyond, just the size of a company, another factor that seems to affect these seasonal patterns is the investment style, specifically how growth stocks perform versus value stocks.
Yeah, there's definitely a distinction there, and data shows that value stocks tend to do better than growth stocks in January and during, the first half of the year.
While growth stocks often start to pick up steam, in the second half of the year, what would explain this difference in performance between growth and value stocks, throughout the year?
Well, one theory is that when there's economic uncertainty, investors tend to kind of gravitate towards those value stocks. They're often seen as more stable, less risky because they represent companies with, strong fundamentals.
Okay.
And then as the economy starts to get stronger and investors feel more comfortable taking risks, they might shift their focus back over to growth stocks, which have the potential for higher returns. But of course, they also come with, higher volatility.
So it's almost like a cyclical shift in investor sentiment, favoring value when things are uncertain, and then growth, when the economy is expanding.
Yeah, and it's also worth mentioning that different sectors within the market tend to do better at different times of the year as well.
Right. Like retail stocks often see a boost in that fourth quarter, right, leading up to the holidays.
Exactly.
And energy stocks might get a surge during the summer months when demand for fuel is usually higher.
Right.
So understanding these, sector-specific trends can also be really useful for investors, who are trying to optimize their portfolios.
Yeah, for sure.
So we've covered a lot of data on seasonal patterns, but what are some of the underlying explanations for these trends? Why do they happen?
Well, one prominent theory is the Halloween effect.
Okay.
And this suggests that investors tend to sell their stocks in May and then buy back in around Halloween.
Interesting.
And this behavior isn't necessarily based on like fundamental reasons, but more on investor psychology.
How does investor psychology play a role in this pattern?
Well, people might be more likely to sell during the summer months because they're focused on vacations or traveling.
Makes sense.
Just other leisure activities. And this selling pressure could contribute to those lower stock prices. And then, when summer ends and investors come back to the market feeling a bit more optimistic, they might drive those prices back up.
So it's like almost a self-fulfilling prophecy driven by, how investors are acting collectively.
Exactly. Another factor that probably influences seasonality is the impact of investment flows, especially from institutional investors.
Okay.
So these large players, they often rebalance their portfolios at the end of the year, and this can have a really big impact on stock prices.
And individual investors can contribute to these flows too, right? Especially if they're getting year-end bonuses or tax refunds, that could lead to, more buying in certain months.
Right, exactly.
So it's like a combination of investor behavior and institutional activity that probably contributes to these seasonal patterns.
Yeah.
It's really cool how all these different things, like individual psychology and these institutional practices, all come together and shape these market trends.
It definitely highlights like the complexity and the dynamic nature of financial markets.
So we've looked at a lot of data, but it's also important to consider what experts in the field are saying. What are some, opinions and predictions from seasoned professionals about seasonality?
Right. So Adam Turnquist, who's the chief technical strategist at LPL Financial, he he cautions investors against just relying on historical trends.
Okay.
So he says that while seasonality can provide useful information, it's really important to also consider technical factors and the overall market conditions when making investment decisions.
Except.
And Lance Roberts, chief investment strategist at RIA Advisors, he has a slightly different perspective. He actually believes that this sell in May and go away idea might be more about investor psychology than it is about actual underlying economic fundamentals.
So while seasonality might have a role, it's not the only thing driving market movements. And other factors like, economic data, corporate earnings, and geopolitical events, those all have a big influence too.
Absolutely.
Now, looking ahead to 2025, analysts have put forth a range of predictions for the S&P 500, with gains potentially ranging from a somewhat modest 9% to a more optimistic 19.5%.
And these predictions take into account various factors like expected earnings trends, the current non-recessionary economic environment, and of course, the potential impact of seasonality.
But this pretty wide range of predictions also shows how difficult it really is to predict the market accurately. There's so many factors in play.
Yeah.
And unforeseen events can change everything really quickly. It's a good reminder that while we can look at the data, consider what the experts think, the market is always going to have that element of unpredictability.
Always. So this kind of brings us back to the heart of our discussion, stock market seasonality.
Yeah, we've dug through a lot of data.
Yeah.
Spotted some pretty cool patterns, and even heard from experts who have different views on all of this.
Right. So what can you, as an investor, as a professional in this space, what can you take away from all of this information?
Yeah, I mean, that's the big question, right? How can we use these insights to actually make better investment decisions?
So first things first, we got to remember that these historical seasonality trends, they're interesting, they're informative, but they're definitely not guarantees.
Right. The market it's a wild beast. It's affected by all sorts of things: global economics, interest rates, investor sentiment, even global events, geopolitics, you name it.
Yeah, for sure. And as we saw, recent anomalies, like how well May 2024 did, that can kind of throw a wrench in those traditional seasonal expectations.
Exactly. So treating seasonality as like a surefire trading strategy, that's probably not the best idea.
Right, but that doesn't mean that seasonality has no relevance at all.
Right, right. The data does seem to show that some months have historically been, better for certain indices.
And knowing these patterns can be like a really valuable piece of information when you're making investment decisions.
Yeah, like for example, if you're thinking about adding some small cap exposure to your portfolio, that mid-December to mid-February window, when they've historically done well, yeah, that might be a good time to jump in.
Right, or maybe you're looking for opportunities in value stocks, January and that first part of the year. That might be something to watch closely.
Yeah, but again, it's important to remember that these are just like pieces of the puzzle. It's not the whole picture. Your own personal risk tolerance, your investment goals, and just the overall market situation, those should always come first, when you're making any decisions about your investments.
For sure.
I think one of the big takeaways from our deep dive today is that understanding seasonality can really add like another layer of depth to your investment strategy.
It's not about blindly following those historical trends, but more about incorporating that knowledge into how you make decisions.
Right. Right. And seasonality is just one factor among many. We can't forget about those other key elements like how the company's actually doing, its fundamentals, economic indicators, and industry trends.
Absolutely. Now, as we start to wrap up our discussion, I think it would be good to leave you with like a thought-provoking question to think about.
Yeah, I'm all ears.
So with all these things affecting the market seasonality, economic data, how investors are behaving, is it even possible to consistently beat the market?
That's a question I think a lot of people have been asking themselves, for years.
Yeah, there's no easy answer, but it's definitely a question worth thinking about, as you kind of work your way through the market.
For sure. And I think, whether you're someone who's trying to time the market or you prefer that kind of long-term buy and hold approach, just understanding these little details of seasonality, it can definitely help you understand things better and maybe refine your strategy a little bit.
Yeah, and if you're really interested in this whole seasonality thing, it's definitely worth looking into it more. There's a ton of research out there, academic studies, commentary from people who've been in the market forever.
That's a great point.
Yeah.
And as always, we encourage you to do your own research, look at different perspectives, and ultimately, make decisions that work for you, for your goals and your risk tolerance.
Absolutely.
So as we wrap up our first market dive, deep dive, we want to thank you for joining us, on this journey into stock market seasonality.
We hope you found it helpful, engaging, and maybe it even gave you some new ideas for your own investing.
And we're excited to bring you more deep dives in the future, covering all sorts of topics that matter to investors like you.
So stay tuned, keep those great questions coming, and let's keep exploring this crazy world of finance together.
Until next time, happy investing.